You ever look at a SaaS company and wonder how they go from a simple dashboard of numbers to a massive multi-million-dollar valuation? Well, today we're going to decode that. We're talking about the two financial languages of SaaS and how translating between them is the secret to turning metrics into millions.
Because, it really all boils down to this one question. A company can look like it's just exploding, right? But for the investors, the people with the checkbooks, not all growth is the same. So how do you actually tell the difference between a flash in the pan and a business that's built to last?
Okay, here's the key idea. Think of it like this. Founders and investors, they basically speak two different languages. The founder, the operator, they're fluent in the day-to-day data, the dashboard. But the boardroom, they need to hear a story, a strategic story about long-term, durable value. And that's our job today. We're going to be your translator.
So let's start with that first language, the operator's view. We're going to open up the toolkit and look at the absolute building blocks, the foundational metrics every single SaaS founder has to know like the back of their hand.
First up is the absolute king of SaaS metrics, MRR. That's monthly recurring revenue. And this isn't just some number. It's the predictable pulse, the very lifeblood of the business. Now, here's the crucial part. It is only the recurring subscription income. Any of those one-time fees, like for implementation or consulting? Nope, they don't count. It is all about that beautiful, predictable revenue stream.
Let's look at a real example. So the company's total revenue for the month was over 67 grand. Looks pretty good, right? But look closer. The MRR, the part that really matters, is actually under 53,000. That $14,000 gap, that's all one-time stuff. To a smart investor, that money is almost invisible. They have laser focus on that predictable recurring number.
Okay, so this business, they grew their MRR by a super healthy 22% in just 1 month. That's a fantastic headline number. You'd want to shout that from the rooftops. But the really smart question isn't just how much did you grow? It's how did you grow? What's actually hiding inside that 22%?
And here is the story behind that number. So they brought in new business, about $5,200. Great. But look at this. Expansion MRR was even bigger at $5,500. That means over half their growth came from existing customers upgrading or buying more. That is a massive green flag. It shows the product is sticky and valuable. And then you see churn, the money they lost. The fact that expansion revenue is more than 4 times bigger than their churn? Wow, that is the sign of a seriously healthy business.
So growing is one thing, but is that growth actually profitable? Is it sustainable for the long haul? This next set of metrics helps us peel back the onion and understand if the whole business model actually works.
All right, next we got to talk about LTV, or Customer Lifetime Value. This isn't just what a customer pays you in a given month. Nope. This is about the total profit you can expect to make from them over their entire relationship with you. It's the big picture, the long-term view of what a customer is really worth.
But of course, getting that customer in the door isn't free. That's where CAC comes in. Customer Acquisition Cost. It's pretty simple, really. It's the total amount you spend on sales and marketing, all of it, just to win one single new customer.
And now, the magic happens. You take your LTV, you divide it by your CAC, and you get this beautiful number, 6.03. Now, just to put that in perspective for you, a ratio of 3 to 1 is considered good, 5 to 1 is great, but over 6, that is absolutely exceptional. It means for every single dollar they spend to get a customer, they're getting more than $6 back in pure profit. That is an incredibly efficient growth engine. Okay, so we've got the operator's language down. Now it's time to shift gears. Let's walk out of the weeds and into the boardroom. This is where we translate all those daily metrics into the language investors really care about. Long-term strategic value. This slide just nails the difference in mindset. The founder is tracking the what, MRR growth, churn, but the board, they're asking about the so what. They see MRR growth and ask, yeah, but is it durable? They see churn and ask, okay, but what's our net revenue retention? It's all about looking past the number to the story it's telling about the future.
And NRR, you could argue, is the most important boardroom metric of them all. It basically asks, what would happen to our revenue if we just stopped trying to get new customers today? If your existing customers expand enough to make up for those who leave, your NRR is over 100%. Anything over 110% is considered top tier. It's the ultimate sign of a sticky product that customers love.
Man, this quote says everything. If you have one giant customer and losing them could cripple your business, well, you don't really have stable growth, do you? you have a huge liability. A board looks at that and doesn't see success. They see a massive red flag that just screams risk.
And all of this, it all leads to the final test, the final boss, if you will. Is this company's financial story strong enough to go public? This is where the scrutiny gets incredibly intense, and even small cracks in the story can turn into major, deal-breaking problems.
These right here, these are the valuation killers. Public market investors, they will dig into everything. Is your growth just propped up by crazy discounts that you can't sustain? Are your books a mess? Do you have way too many eggs in one customer's basket? These aren't just little oopsies. These are foundational cracks that can bring the whole valuation crashing down. So imagine you're in the big meeting. You're getting ready to go public. You put this slide up, 38% annual recurring revenue growth. It looks amazing. High fives all around, right?
Well, not so fast, because the very next question out of every investor's mouth is going to be, but is it predictable? Can you do that again next year? And the year after that? And the year after that?
And this, right here, is the fundamental shift in thinking. When you're a private startup, velocity, just raw speed, is everything. But in the public markets, it is all about consistency. It's about predictability. They'd rather see a slightly slower but rock-solid predictable growth rate than a crazy volatile one. They're investing for the next 10 years, not just the next 10 months.
So, what's the big takeaway from all of this? Building a company that's worth billions isn't just about being the fastest car on the track. It's about being the most resilient. It's about building a story of predictable, efficient, and durable growth. And that, my friends, is how you truly translate metrics into millions.